There is an opportunity right now in the HIMS and HERS stock. It's the HIMS, ticker HIMS. It's a subscription company that delivers pharmaceutical drugs to your doorstep via an online model. The stock is absolutely ripping right now. There's a couple very interesting aspects to this stock that I want to break down for you, including an amazing short squeeze opportunity. But there's some key elements of this stock. I'm going to lay out an argument where I think this stock could potentially go up 5 to 10 times over the next however many years. You pick your scenario here. But I'm going to lay out a case. I don't know if I believe this necessarily, but I want to smell check it with you all. Let me know what you think. There's a lot to unpack here. There's definitely a lot of risk and a lot of uncertainty. But I'm going to lay the case out there why this stock could continue to go a lot higher, and I want to get your feedback on it to see what you think. You ready? Let's get to work. All right, first things first, let's cover some basics. Let's look at the stock and what it has done recently. In the last, say, year or so, has absolutely ripped from, say, $7 to about $50 a share. Absolute monster movement in this stock. Couple interesting things to note. The CEO, we're here in the Cash Flow Club, one of our write-ups. The CEO of the stock owns 90% of the voting share. So it's going to be very interesting. This individual controls all the votings. He can determine if the company is sold or merged. He can kick off all the board of directors. He can do basically whatever he wants to this business. So if you're buying as a shareholder, know that you have absolutely no power or influence over this company. And there's not a point in time when a Bill Ackman or some kind of third-party hedge fund manager can accumulate enough shares to have a proxy battle here. You're basically at the whim of the chairman, CEO, who owns 90% of the voting stock. Other interesting to think to see here is that HIMS is one of the most shorted stocks right now in the stock market, with a massive 30% short interest in this company. You could potentially have a giant short squeeze if those shorts need to cover. The stock could absolutely rip higher, like we've seen in prior stocks with GameStop and others. This stock in particular is very interesting because it does actually have cash flow. It is growing revenue. It has wide margins, so it's a little different than your GameStop retail stock. Here's a 30% outstanding of short interest. And one of the HIMS house on X was kind of calling out as a monster short interest stock. Let's go through the financials. They just released their annual report. I want to look through that, smell check the balance sheet, understand the cash flow a little bit more and the income statement. Then I want to go to their earnings presentation, understand what that looks like. And then finally, I'm going to build a case for you to judge on your own if you think this stock could go up 500 or 1,000%. Ready? Let's do this. Okay, very first thing, let's pull up the annual report here. This is 2024, HIMS and HERS Health LLC, Inc., the balance sheet. This company was formulated in 2020 and 21 with a couple mergers of different entities. You're going to see that when we get to the goodwill section. But for right now, let's just stick with current assets. Cash on hand, $97 billion. That's up from 64 year over year. Short-term investments, 142 and 132. One thing I wanted to call out right away is just that the combination of these two numbers here, let's call that $225 million. These are all in thousands. $225 million. And then this here is 180 million roughly. All I'm trying to say here is it looks to me like cash balance grew year over year, which is a great thing to see in a business. We'll see how they actually generated that money. But for right now, the very first observation, cash is large and cash has grown year over year. The next thing I noticed is for a supplements company, inventory is extremely low relative to cash, and inventory has not moved high relative to so much revenue that they've gone. They're really not carrying a tremendous amount of inventory. That's going to mean they don't have to put out cash to source the inventory and then hold it, waiting to sell it to customers. So I think that's a very interesting element to their business model. Prepaid expenses, so current assets, $265 million. Restricted cash, fine. Goodwill, $100 million. That's a lot of goodwill, and that relates to the acquisitions that they did when they put this HIMS and HERS together with another, I think it's ORCOAC. It looked like it was a reverse merge into that business. So this goodwill here is very large and is basically them overpaying for the reverse merge. Property, plant, and equipment, $36 million. Not much. Intangible assets, 18. So really, the balance sheet of $141 million is predominantly, more than half of it, about half, is current assets, which I like. I'd like to see more physical assets, but they don't manufacture anything. They're an online internet company. I don't expect them to have a lot of buildings and office space and retail space, so the assets can be fairly light here. Liabilities, what do they actually have to do? $88 million in liabilities. That's basically accounts payable, fine, decent move year over year, not a big deal. Accrued liabilities, again, not too much of an issue. Some deferred revenue, definitely growing in the deferred revenue, but might be manageable. And there's an earnout, some sort of like tail for an acquisition that they made, they might have to pay out. But overall, the current liabilities are a lot less. Liabilities are a lot less than current assets. Love the check the box. That's Ben Graham special right there. In fact, cash on hand and short-term investments of almost $200 million can wipe out all liabilities at $100 million. So they have a lot of staying power here. These guys have a lot of assets that if they can figure out how to monetize their customer base, which they might be getting to do, they have a lot of dry powder here to go and expand and continue to market and continue to grow the business. That's really nice foundation that they have to grow off of. Operating leases here, this must be some rental space that they have, very, very small. And look, no long-term debt. So you as a stock owner here, from a collateral position, I guess you're protected. However, the CEO has 90% share of voting stock. So if you got into a bankruptcy, you're going to be basically at his mercy. So you're not going for this stock for really a collateral position, but it is nice to see that they have a lot of assets that they can use to generate income. Let's take a look at the income statement here. So you got 3 years of income. Top line revenue has grown from $271 million to $526 million. It's kind of a doubling. And then to $872 million over the 3-year period of time. That's basically a doubling and then maybe like 40% increase or so the following year. Phenomenal growth. What I think is more interesting here, however, is the gross profit margin at about 82%. They have very little costs for their medication, which surprises me a lot. I know that they use a compounding pharmacy to manufacture their products. They use third parties to deliver the products. But still, that seems really low to me. And I would have guessed that they'd have a lot lower gross margin. So I think for me, my only reservation of this stock is this cost right? Are they actually expensing the true cost of their products? I read through the 10K and how they define cost of revenue. It does look like just the language says they are expensing the cost of products as they deliver them to the customer. It's stated at the inventory stated at the lower of cost or replacement value. That seems to check the box from an accounting perspective. I'm just surprised that their margins are so wide at a gross profit level. And what that lets them do is it lets them pump a tremendous amount of cash into marketing. This is growing their brand. It's leading to the revenue growth. And in theory, because they're selling prescriptions and they have a subscription model, if they had to dial this number back in the future, they would keep their existing customers to some degree, and they could generate more cash by modulating this number down and instantly lowering the cost of the P&L and move that money to the profit, to the income statement, to the bottom line. Operations and support, okay, that seems to be growing, but not nearly as fast. Actually in line with revenue. Technology development, okay, and then general administrative costs seems to be pretty steady, and I like to see that. So that's your operating leverage here. You've got a HQ, leadership, all that baked in here, and that's basically $100 million, but it hasn't grown over the last 3 years, while revenue is up 4x, 3x. Very nice to see that. And then they did squeak out, so then the operating loss is negative 3 years running, but the loss is declining from a negative 111 to a negative 68 to a negative 29. That is at least improvement. It's going in the right direction. It's consistent. They seem to be gaining operating leverage. I do like that very much, actually. And then basic, so the weighted average shares, basic and diluted, about 209 million shares outstanding. They are issuing shares, so that dilution is weighing on the shareholders' return. But if they're able to grow fast enough, and it has less of an impact. Let's take a look at cash flow here. So cash flow I thought was interesting. Here's your $23 million loss last year. Stock-based comp is hefty, but not too bad. This is $66 million that was paid last year, but they made $800 million in stock. So that's 8% or so of revenue. Still a high number, but perhaps if they continue to grow, this number doesn't seem to be scaling with revenue, so perhaps that will level off and revenue will continue growing, and it will become a smaller number over a long period of time. Then some of the other ones, net cash from operating leases, non-cash charges for acquisitions, okay. So cash was laid out for prepaid expenses, very little for inventory last period. It looks like it was higher in previous periods. That's interesting. That might be a one-time fluke. That might come back up. Let's see here, accrued liabilities, they kind of put in actually $16 million. I might adjust this number here, this $73 million of positive cash flow. I might adjust that down. Well, for this 16, that seems abnormal. I'd take inventory up a little bit, and then if you expense the $66 million of stock-based comp, then this $73 million is actually negative. So that doesn't bode well. But I will say that I do like the patterning here. They've got $30 million loss, $26 million loss, and a positive 73. Even adjusting all of these, you'd still kind of have the same pattern. It looks like that the losses are shrinking and cash generation is arriving. It's not very strong. You're definitely not going to buy this stock for its cash flow. It looks to me like they're putting most all of it into marketing to grow the top line revenue, and maybe they don't want to show a profit or high free cash flow right now. They have no debt, so they might not have to really generate a lot of free cash. On the cash flow from an investing section, it's these two lines that you really want to look at. The development of software, right, because they're an online company, so they're investing in their infrastructure, and then the property, plant, and equipment, the tangible assets they buy. This is extremely low. $26 million a year on a business that's doing $800 million of revenue. Very, very low. They really don't have to put much back into this business. So I think that means that most of the revenue they earn, or gross profit, because COGS are so low, they can afford to put back in marketing and actually not lose too much, right? We've seen a lot of other stocks in this channel that are growth stocks with extremely high multiples, very rapid revenue growth, but they seem to consume a lot more in cash, or worse, their losses scale as revenue scales. And what I like here is it looks to me like as their top line revenue is scaling here, it looks to me like the losses are coming down, that you're actually realizing the operating leverage because your general administrative cost is somewhat flat. They're scaling marketing fine, but that marketing is translating into more output, more customers. So I guess I'm either justifying a bad investment by looking at the highlights only and glossing over cash flow a little bit, or I'm trying to say, hey, look, let's put our long-term glasses on here for a little bit and think this is a really interesting business model. if they can scale it or continue to scale it over the long term, perhaps there's something real here. So let's take a look at their most recent investor deck and go through it and see what aspects we can glean from their business model by going through this investor presentation that was released back in May 2024. So first, kind of a giant suite of people all wearing black. Good for them. Lots of brands. They don't really give resumes anymore, but just kind of brand names that you don't even know if this person was like in the mailroom of Google, but they've got a Google logo there. So I guess it's trying to imply that she was legal officer of Google. I don't know if that's true or not. But here you go. Andrew. Andrew's the CEO and co-founder. Limited background, looked like he did his undergraduate at Harvard, and had business school at the Wharton School, and the Atomic was his startup. It's his claim to fame. Trying to think if Wharton, did I name that right? Wharton's Harvard or is Wharton Columbia? It's too late. I should be going to bed because I'm traveling and making a video on stocks, but let's move forward. So here is their kind of suite of portfolio. We continue to address large unmet market opportunity, which is absolutely true. Weight loss, tremendous market, 100 billion plus. Mental health, dermatology, and sexual wellness, sexual health, absolutely monster markets. Totally agree. It looks like they've kind of picked out a portfolio within each group, and they're saying, hey, there's some other stuff that we can add on in the future for incremental growth. I think that's very interesting. I will call out that one area of interest here is this weight loss. The Ozempic, the Zepbound, these GLP-1s have been extremely popular in the United States, very fast growing. But the new compounding rule, right, they were allowed to be manufactured through compounding organizations because they were a short supply. When they've been taken off the short supply list, now you have to buy them directly from the manufacturer. You have to buy them from the Eli Lilly's of the world, the Novartis of the world. So the low cost option for those products is going away. It's becoming harder to get. So I know at least the Ozempic, what they're trying to do is go directly to the manufacturer. You would write a prescription as a provider and then take it directly to the Ozempic company, the headquarters, I'm forgetting the name, but they would then fulfill it directly if you had a prescription via an online service. So I think the weight loss, potentially, I know it's been really huge for them recently in terms of their earnings. There's a potential that this could slow. However, they do seem to have a portfolio here. This deck does not say what percentage weight loss is of their overall revenue, so it's hard for me to benchmark this risk, but I will say that there is a risk here that their revenue will slow down as a result of the changes in the compounding regulations in the United States. So long as they can lean into these other ones, they should be able to continue. So this is just basically the subscribers. I thought it was interesting that a lot of their, personalized versus non-personalized appointments growing. I want to get to the subscriber one in a second because I thought it was really interesting how their subscription model is stacking and how their average revenue per sale is pretty low. I'll get there in a second. In terms of infrastructure that they've built, 800 plus providers, 24-hour service, it's all telehealth. I think that's a winning strategy, and they seem to be the leading player in it. Different brands, different products. Kind of fast forwarding through this. That's market, and this is interesting. This is market share within the telehealth world. It's not all healthcare. I wish there was a bit more market data in this overall deck. I think it's pretty weak from my perspective. But it does say that, hey, look, among these 5 brands, we're growing. Okay, great. But, how big are you in the entire GLP-1 marketplace? How big are you in the entire, sexual wellness space? Just picking telehealth, I think, ignores the giant healthcare market. So on the one hand, they're saying, look at us, we can play in these multi-billion-dollar markets. On the other hand, they're saying, hey, we're doing really well within this subset of telehealth. And I think that's a little bit of having their cake and eat it too. So here you go, 40% year over year subscriber growth, 1.2 million subscribers in Q3, 1.7 in Q4, okay. Revenue growth, 46% from Q1 of 3 to Q1 of 2024, very nice. Adjusted EBITDA margin, we'll get into this, 8.4%. Let's dive in, let's keep moving. Here we go. This is really the slide that I wanted to show you. I thought that their subscriber count, this pattern here is actually extremely consistent. They seem to be able to spend money in marketing, drive customer engagement. Those customers sign up on a prescription method, and they seem to be able to retain them over long term, which is very, very nice. Again, online revenue is the vast majority of all their sales. They have a little bit of wholesale risk. So that means that very little customer concentration. No one customer is a big piece of their business, which is nice. And their average revenue, which is this line, the average revenue per ticket is extremely small. Monthly online revenue per average subscriber, $50, $53. Very, very small in terms of the dollar amount. So perhaps that means in an economic downturn, those customers will continue to take their prescription and kind of stay on. They'll cut something else. They'll cut the Netflix subscription. They'll cut PS4 or whatever they're doing, but they'll stay on their hair topical treatment. They'll stay on their weight loss meds. They'll stay on their mental health medications. So that might be an underlying benefit here of having a prescription medication customer. Here's their quarterly revenue and gross margin. Gross margin has grown nicely. I don't know if this growth here is attributable to the explosion in the GLP-1s, and it kind of reverted down a little bit. Does that mean it's going to kind of cascade back down and the ride is over? I didn't get any information on that in the deck, so it's kind of a nice slide, but it's hard to really judge what's going to do in the future. Adjusted EBITDA margin and dollar amount. Okay, we're going to figure out what's in adjusted margin in a second. But they're saying, look, we're in low double digits. They're going to say that they're going to get that number to 20 to 30% over time, and here's the dollar amount. Okay, here's some FY 2024 results. Revenue. This is the outlook for 2024. Anticipate strong top-line growth and continued leverage. They've got fiscal year 2024 at 1.2 to 1.23 billion, or 38 to 40% growth, 85% retention, very nice. Expanded portfolio, strong economics for payback less than 1 year. That's fantastic. I mean, I'd like payback on the first transaction, but I guess they're saying, hey, it's going to take them a little bit to do that. See what that looks like. Payback period defined as the time it takes quarterly cumulative online gross profit generated HIMS online customer to exceed the quarterly customer acquisition cost. Well, that's interesting. Gross profit, payback period. Payback period is only paying off the gross profit. I guess that's okay. So you pay. Let's say you pay $100, maybe $200 for a customer online. They bring in $50 of revenue, so you need 4 transactions to generate revenue of $200 for the customer, but you have gross profits, you get 80% of that $200. That's $160 of profit. You paid $200 for the customers. You need an extra turn. You need 5 transactions in a year, assuming some rudimentary math here, to make that gross margin pay for the customer. And then after that, the customer is pure profit. Well, after that, the margin on the customer goes up to that 80% because you would have paid for the customer acquisition cost. So I get how they're doing. I would like to see that, the payback period be on a transaction or two, but I guess they are going for scale. They certainly have the cash to withstand the working capital, the time it takes to get that payback period. But here's their adjusted EBITDA. They're saying $120 to $130 million, and they're at 10 to 11% adjusted EBITDA. This one's interesting. This is long-term profitability targets. Long-term estimated is 20 to 30%. Okay, let's see what they define as adjusted EBITDA. Here's their adjusted EBITDA quarterly. So revenue last quarter, $278 million. They had a positive income of 11. But what do they add back? Oh, stock-based compensation. God, they love adding that back. That is an actual cost. Stop adding that back. That is not an add back. Stock-based comp is compensation. It's like adding employee salaries back into your profit line. It's garbage. Don't do it. Depreciation, amortization, check. That's fine. Provision for income taxes, fine. Transactions and acquisition-related costs, fine. Impairment losses, okay. Changes in fair value liability, fine. And interest income, okay. What's interesting here is actually there's very few add backs, aside from the one I don't like, stock-based comp, okay. But overall, there's very few others here that they're putting in, which is pretty clean. I don't like the 19. I'd have this $19 million less. So I would say that in general, they are profitable on an EBITDA basis. And it looks to me like that trend of loss to profit is actually happening. I'm arguing kind of a small piece that I would like to see stock-based comp expensed. It still means that they'd be profitable on an adjusted EBITDA basis, and the trend is going in the right direction. Cash flow. Again, the stock is not going to be a cash flowing, dividend paying asset that you want. It's got a lot of speculation in it, but in general, again, the patterning is the same way. So when we look at like cash costs on the P&L versus income statement, they do both seem to be going the same direction. So I don't think there's much funny business here. I'm still shocked at their gross margin, and so I still think that is a little shocking, to use the same word twice. But overall, very, very interesting. So let's step into the world of what if. Okay, so this company's growing. They crossed $1 billion of revenue. They seem to be scaling. They're in a big market. What could they do out multiple years? I have no idea. But I put together a handy dandy Excel sheet just for you guys to kind of see in this late evening. So what I wanted to do is I want to say, let's throw out a revenue target here of $5 to $20 billion. How long is this out? I have no idea. Don't know. Are they going to hit these numbers? No idea either. But I want to try to scale what's possible and judge the downside risk of losing your money versus the upside that maybe 3, 5, 10 years out, they're able to continue to grow to some degree and hit a revenue target of $5, $10, or $20 million. They did not give any kind of guidance. I literally made these numbers up as a way to judge possibility. They gave us an adjusted EBITDA margin. I took the bottom, 20%. They should easily be able to make 20% margin given their gross margin of 80%. It was certainly at these revenue numbers. SG&A would not grow too much more. Their marketing would, but hopefully they, either keep that or scale it back just enough to squeak out 20% EBITDA margin. And I'm assuming in this EBITDA margin we are expensing stock-based comp, so that's why I took the lower of the range. That means I got a long-term EBITDA target of $1 billion to $4 billion of profit. I think it's a reasonable number given this company's growth rate in the long term. Well, let me phrase that. The reasonable calculation, I don't know if this is achievable for them, but I think the math foots 20% of $220 billion is $4 billion. EBITDA market multiple. You guys are going to give me hell for this one. But I went up on this multiple a lot, actually, 30x. Over the last couple of years, I've watched some of these stocks go ballistic, and assigning a 16, 18% market multiple, something like that, is just unreasonable. Right now, their market multiple's triple digit. I'm not going to give it that, but I will say that something that's growing this fast with these kind of margins, if it can continue to be profitable, if cash flow can continue to grow, and if they keep no debt on the balance sheet, it could trade easily at 30 times. So I put a 30 times handle on it. You be the judge. If you want higher or lower, you can do your own math. But that gives me an enterprise value estimate range of $30 to $120 billion. For the sake of simplicity, I've zeroed out debt, which we covered before, aside from the earn out of $7 billion, which would be gone by the time this happens in the future. They have no debt. And cash are left on the balance sheet because they are using the cash to invest in marketing. Their free cash flow is very thin, so they want them to have that war chest. And I said as a simplicity, simplifying argument here that enterprise value is going to equal market cap. Shares outstanding, 210 million shares. That's a Yahoo Finance number. I think you and I saw 209 or so on their P&L. They'll probably issue more shares between now and this future date. So these shares will be a lot higher than this, but I don't know what they're going to issue. And I've assumed a lower margin, a lower EBITDA margin, having expensed all the share issuances. So I've held these shares constant. That gives me a price target of $143 to $571. Again, out at some undetermined point in the future. I'm not doing a DCF. I'm just doing real high investment banker math, which, believe it if you want, this is what they do. So there you go. There's your range. You can currently buy the stock for $50 a share. That means on a cash on cash return basis, you bought it at 50. I don't need these zeros. You bought it at 50. You sell it at 143. That's 2.9 times your money, almost 3x. On the high end here, that's 11x. So there you go. There's a range of 2 to 10 times your money out into the future, some indeterminate amount of time. If you believe they can continue to buy customers with a payback period of less than a year, they should be able to continue to scale that as they widen their services. Couple huge caveats. One, like I said, the CEO controls 90% of the voting share of the stock. So whatever he does in the future, he controls everything. That's a huge flag. It was a huge flag for me for Facebook, some of the Google stock. I eventually got over it after they proved out that they did so well. But for me personally, it took me a while to get into those stocks. I'm trying to take a lesson from that on this one and just saying, hey, I'm going to trust this guy, that he has a lot invested in here and he wants to see a big outcome. So I'll go along for the ride. Number two, there's a very large short interest here. There's 30% outstanding shares that are short. I think that short is coming from the compounding change in the legislature. And if this stock has a high percentage of revenue in the weight loss compounding world, you could see revenue take a hit, which means the share price would fall considerably. I think that's a big risk. That's why there's a huge 30% short interest outstanding. If that proves to be wrong, then there could be a short squeeze to go to the upside. Also, the last thing I'll say about the risk here is their gross profit margin, their COGS, the cost of revenue number, seems very low to me for a pharmaceutical drug company. Even though they outsource it to pharmacies to do the fulfillment, doesn't make sense to me why they can make so much money from a patient that is buying a subscription from them, outsourcing it. I'm a little confused in the business model. Help me out. If you use their business model, do you have to pay the compounder for the drug itself? Or once you pay HIMS and HERS, that's all the payment, you get the drug in the mail? Very interesting. If that's the case, they're able to make these drugs at an extremely low price, which I guess is good for the consumer. So there you go. There's the HIM and HERS 500 to 10,000% return, 5x to 10x on the HIM stock. Let me know what you think. Throw a comment down below. Helps the algorithm. Let me know what stock you want to see next, and I'm happy to run through it. All right. Take it easy. Take care. Oh, yeah. Before we go, one more thing. If you like this content, hit the like, subscribe, greatly appreciate it. Also, check out this link in my description. If you want to learn how to value stocks, I teach a whole course on valuing stocks, and sign up for the Cash Flow Club. It's a one-pager we distribute on lots of companies that are generating tremendous cash flow. We look for 5 key things. We want companies with revenue growth. We want them with growing earnings. We want strong free cash flow, low debt, and you want to buy them at a reasonable price. We publish that in our Cash Flow Club, and you can join it and get investment ideas for your consideration. All right, that's it for the night. Thank you very much. Bye-bye.